Okay, then it's about time to get our webinar started with some initial comments to give others a chance to join us still if they're not in. Today's panel is about forensic accountant. My name is Rudy Müller, and I'm the moderator. And I have two fantastic forensic accountants here as my experts because I'm actually a turnaround guy. And the only thing I know about forensic accountant is when I need them and when I have to yell help. So give it another 2 minutes before we formally get started. In the meantime, if anybody throughout the seminar or the panel here has questions, please go to the Q&A feature at the bottom of your screen, post your questions, and I will try to get them answered by our experts. So give it another maybe minute or two. And of course, the silence is deafening.
I would sing you a song, but I don't think that'd be a good idea.
So I think it's about time to get started. And I'm going to start with our introductions. We have, and I go in the order in which our panelists appear on the screen. In my upper left-hand corner is the formidable Andrea Bone, a forensic accountant from the Tampa Bay area. I've worked with Andrea on several cases and have never had a problem, get fantastic work out of her. And sometimes I think it goes beyond just forensic accountants and into outright detective work. So Andrea has her own firm. She has accountants scattered in multiple countries. Her customer base is primarily in the Southeast. Andrea, correct me if I'm wrong, as far west as Alabama. And
we're actually up to New Jersey now and all the way over to Colorado and California. I think we've got 17 or 18 states now.
Okay, so you're in New Jersey. Okay. Yep. She is, in addition to a forensic accountant, also a very successful entrepreneur because she started her company from scratch. It's now very big. And especially in the Tampa Bay bankruptcy area, she has developed a formidable reputation for outstanding work. And pretty much all the major law firms in the area have her in their Rolodex. The second panelist in the order of my screen is Jennifer Gavrich. Jennifer works with BDO. She is a director there, certified fraud examiner and forensic accountant, and has a decade and a half of experience. She has had a few rather interesting cases that she shared with us, including working for the Department of Justice and in areas of shareholder litigation, bankruptcy, family law dispute litigation. So she has a wide range of expertise. And of course, everybody knows the company she works for. BDO is very well known. Now, why do we have a panel on forensic accounting? I have heard a lot of people in my career speaking about forensic accounting, and then you ask them, okay, what is forensic accounting? I said, well, actually, I don't really know. So one of the reasons we have this panel here today is to explain what is forensic accountant? What do they do for us that a bookkeeper, an accountant, or someone else in the accounting and finance world cannot do for us? Why should we pick up the phone and call Jennifer or Andrea and say, help, we need you. Here is why we need you. So without much further ado, let's start with the definition. What is forensic accounting? Let's our experts explain it. Jennifer, if you want to start off, and then you guys continue, Andrea, and you can have a great conversation about what in the Blue Blazes is forensic accounting.
Hi, everyone. Thank you for joining, and thank you for the very kind introduction, Rudy. I would like to, I guess, answer the question relating to the definition of forensic accounting. So the textbook definition of forensic accounting is something to the effect of the forensic accounting is the review and analysis of financial documentation, including bank records, for the purposes of identifying inappropriate transactions resulting from the misappropriation of assets or mishandling of funds in some form. And there are many forms, but that's probably the textbook definition, I would say.
I think the difference between forensic, and I can go into the forensic accounting in difference to a regular accounting. In regular accounting, you're moving the money, you're paying the bills, you're receiving the cash. You're not really looking for any type of, as Jennifer said, any misappropriation of cash or assets. You're doing the day-to-day, bookkeeping type work. When you're looking at more of the forensic accounting, you're going in and you're really putting on your detective hat and you're figuring out what happened and where things went. And to Jennifer's point, it all starts with those bank records. And I think the biggest thing is when we're talking about forensic accounting, it's really about digging. It's about digging into the details of what's happening and looking for those patterns. Whereas regular accounting, you're just really doing the day-to-day operations of the accounting department, producing your budgets, your actuals, your reports for your board. But this is a very different type of accounting and a very different skill set than managing day-to-day operations.
Yes, I think that's very well said. So there are multiple different types of accounting, from managerial accounting to tax accounting, and then, of course, forensic accounting. And when you think about it, if you consider the legal world, right, we would never retain, someone would most likely never retain a trust and estate attorney to assist them with a business litigation dispute. They would hire a commercial litigation attorney to assist with the business litigation dispute. So the difference in the skill set and the training is critical. A lot of people think that all accountants are kind of the same, and I think that we're kind of all placed into a bucket together where we have similar characteristics, similar personalities, but the skill set and really almost the personality skills or personality traits relating to a forensic accountant are very different and unique. Oftentimes, a lot of us are very personable, outgoing people. We like to ask questions. Even if we're introverts, we still really, like to know the answers to questions. We might find it in a different way. Maybe instead of asking a person a question, we'll Google it. But we are constantly, questioning, and we have a lot of skepticism, which is very different than, the rules that form the foundation of, let's say, auditing, where you're only intended to have a, specific level of skepticism. As forensic accountants, we kind of approach every case with skepticism because that's why we were retained. The attorney or the individual that's retaining us believes there to be an issue that has caused some type of mismanagement of money, and we approach the situation looking for that, trying to find that.
I agree. It's definitely a different skill set, and to just reiterate what Jennifer just said, it is a very different, and we all get lumped together in as accountants. Oh, you must do tax, is what people ask me for the last 30 years. No, I do tax now. I have a tax manager, but I don't do tax. I do accounting, forensic accounting, bankruptcy accounting. And so it's very, very different. But I agree with Jennifer. We definitely have a healthy dose of skepticism. I never take things on face value. I want to dig and find the source document. I want to know where the transaction's coming from. I don't trust anybody in the organization. I just trust the data. And the data is what's going to tell us what's actually happening. And it definitely is I always ask people, if you like puzzles, you'll be really, really good at a forensic accounting type role, because that's what it is. You're pulling the puzzle apart completely. You don't have the box top to look at. You're trying to put that puzzle together just by understanding the relationship between certain things. And that has to be a natural characteristic and trait that you have. Because not everybody's going to be able to do that. And which is very specific.
Would it be
Yes.
fair to say that it would be appropriate to rename this panel into How to Commit Financial Fraud? Because you tell everybody what not to do so that they
Yes.
don't.
I've always had a
I
joke.
mean, I don't know if we
I've always
should
had a joke
rename
I
it
can bury the money
officially.
anywhere.
Yeah.
Okay.
Jennifer and I could go into any company and bury money, I can guarantee you, and nobody would find it because we know all the tricks of the trade.
So
But that's not what we do. We're the good guys.
obviously, we're with the TMA. So the TMA deals with distress, and that is an area where forensic accountant has a huge value. Now, in distress, you have situations where companies are in distress, but not in bankruptcy. And then you have the, let's call them basket cases that couldn't stay out of bankruptcy. They were too far gone. They had to enter bankruptcy. Let's discuss these situations and let's share some of your experience. Let's start with no bankruptcy yet. We add that as the whipped cream at the end of the discussion. But let's start with regular distress. If I go as a turnaround guy into a company and I need help, why would I call you? What can you do for me?
Jennifer, you want to go?
You want, okay.
Or you want me to take that one?
No, I can start. So, first of all, and we'll probably touch on this more later. It's good that you're making that call sooner rather than later, because the sooner you make the call, the sooner we get involved, and the sooner we can start to try to figure out what documents you as an attorney need to request or subpoena in those cases. But in a turnaround situation, if we can get involved sooner, then we can start to figure out, we can start to review the financial records and start to figure out where the weaknesses are in the financial activity, where the overspending is, where the misuse of funds is, and try to start to figure out what we can do to improve things for the company.
I agree with Jennifer. The sooner that you get someone involved who can really dig into the numbers, the better your decision making is going to be as the leader. I have a perfect example. Gosh, it's been now 13 years ago. I was brought into a large company down in the Caribbean, and I was brought down I was brought down originally as a consultant, and then they hired me. But I went in. They couldn't figure out what was going on with the company. They had no working financial software for 3 years. And it was a $20 million company. And they literally had no working accounting software for 3 years. And nobody could really tell them why. Everybody kept working on it, but never figuring anything out. I was brought into the company and kind of just went down and did an assessment, and then figured out that they had 19 people in the accounting department who didn't even know what a chart of accounts was. And it was shocking, but they brought me in to figure out where the money was going, because they never had any money, and it was a $20 million company. And over the next 2 to 3 years, we peeled back the onion and found multiple issues. And the sooner that they brought me in, the sooner we got it fixed. And I'm sure Jennifer's been in the exact same scenario where you get in and you figure out exactly what's going on, because the leadership can only trust the financial reporting to the level of what's being done. And if you don't know how to dig behind those numbers in those reports, you're taking everything at face value. And generally when there's a $20 million company and there's not $1 left over at the end of the day, there's something going on.
And here's actually our first question that kind of, sorry, relates to what you just said. What about M&A situations? Very often, companies acquire another company, they do their due diligence, and yet somewhere something goes wrong later on. They find things that during due diligence were not discovered. What is it you can bring to the table, and how so?
So I think that during those merger and acquisition conversations, it's really important to get a valuation specialist involved to review the records, the books and records, and determine the value of the company or the sale or whatever it might be that is being acquired or merged together. Because and of course, as all of you know, to retain a good attorney that's going to assist you with that merger or acquisition. Because oftentimes when I'm involved in cases relating to a merger or an acquisition, I'm involved after the fact. So the company has already merged with another company, or they've already acquired another company or asset, but they are calling me a little too late. Let's fast forward, 2-3 years past the merger and acquisition. Now suddenly they're realizing that the asset that they have acquired is not as lucrative as they had thought it to be, or that worst case scenario, the liability relating to something, to an asset that they acquired is more than they realized for one reason or another. And yes, that does happen. And then they retain an attorney. They decide that they want to sue, somebody. They want to sue the other party, and then they bring the forensic accountant in. Well, now we're in a situation where because that valuation wasn't completed up front. Now we need to file a lawsuit and retain a forensic accountant to look at books and records from X number of years ago in order to figure out where the loss is and what the value now of the economic damages is. We have interest, we have all sorts of issues that will amplify that situation and cause the analysis, the amount of time, and the dollar cost to increase. So that's my word of caution there. Not necessarily that in the cases that I work in, it's not necessary that a forensic accountant maybe needs to be involved during that merger and acquisition discussion stage. Although Andrea might have, additional insight there where a forensic accountant would be, really beneficial.
And yes, and I've been on the front side. I've actually done quite a few cases where, and more of these I'm hired as an independent consultant for these or through my firm, but I do a lot of due diligence analysis when people are acquiring companies, because they're taking the reports on face value. When someone just gives you a financial statement or 3 years of financial statements and asset listing, you're really going on their word that data is correct. When I do a due diligence, I ask for the general ledger detail. I ask for several months worth of bank reconciliations. So I ask for things that you typically wouldn't ask for, because I want to really see what's going on. And there's also, to discuss the M&A, if you're acquiring the actual entity itself, because maybe there are licenses attached to that entity, maybe there are very specific trademarks that you need to actually buy the previous owner's entity itself, that's really when you want to bring in a forensic accountant, because you're buying that person's dirty laundry. And it's different from buying an asset sale where you're not buying all of the history of that company. But it is still important, because we just had a brand new client just about 3 months ago who bought a company down here close to Naples. And she had an accountant and she had a lawyer, regular accountant, I think it was a tax accountant. And they didn't dig into the numbers, and they didn't help in the negotiations. And at the 11th hour, the person that was selling the company said, "Oh, by the way, you're going to pay me the remaining amount of the accounts receivable balance." after closing, which was never agreed upon and should not have been agreed upon. And then she didn't even know, the owner that was purchasing it had no idea even what the balance was and what that really meant. And she was out of cash 2 months later because all of the available incoming cash was given to the previous owner. And had we been able to dig into the numbers, and she retained me about 3 months after purchasing the company, I dug into the numbers and dug into the history. And in that case, she bought the entity, and she bought all of his historical issues. So we dug into everything and I categorized everything for her. And we just said, here's our high priority to low priority list. And we found out that the numbers just that she was basing her decision on were not as reliable as she initially thought. And so it is a good idea, depending on the size of the acquisition and the factors involved, to get someone in who really can dig in past just the face value of a financial statement.
Yeah, that's great advice, Andrea. If you have, if in Andrea's situation, in her case, she's a forensic accountant with experience dealing with due diligence. So then you kind of have the best of both worlds. If you were to, potentially retain Andrea to assist in that type of matter, then, that's great, because she will have the technical skill and the ability to pay attention to, minute details that will, be beneficial in, reviewing the economic state of, an asset or an entity before that agreement is entered.
And if not, then you call Jennifer.
Yeah.
On the backside.
Okay, so let's move on to some non-M&A situations. Again, let's assume I get called into a company of whatever type because they're in distress. They have problems paying their bills, their borrowing base is maxed out, whatever the case may be. They may even be involved in litigation. What can you do for me? And how do you start?
You want to
I'll
start,
take
Jennifer?
this one. Oh,
Okay, I can start. The first place I always start is the bank. I've always believed and been taught in 30 years that start with the lowest common denominator. And the lowest common denominator is cash. Where's the cash coming from? Where's the cash going? And once you start to figure out that basic transaction model and understanding the business model, that is going to usually lead you down the path that you need to start asking the questions. The second thing I believe firmly is ask questions. You're interviewing people, not in a confrontational way, but you're asking questions. So in a case where you go in, the first thing I want to do is I want to start with the accounting staff, not the controller, not the accounting manager, just the staff. How do you pay the bills? What's the approval process? Is there a budget that you're comparing against to? Is there a 2-signature authority of signing checks? Is there a minimum dollar amount that people can approve and a maximum dollar amount? So you start just by asking very simple questions. I like to gauge the understanding of the accounting staff first. Generally, if your accounting staff is pretty astute and really has legitimate, strong answers to those questions, I believe that everything stems from the top. That means the controller's probably stronger and they might not be involved in anything, but they might be inadvertently pushing transactions through that they're just being told to do. But I like to start with the staff first and then go to the controller and then go to the management team. Once you start having those conversations, things will trigger, and I'm sure Jennifer can agree. As people tell you things, your brain starts thinking, well, what about this and what about that? And as somebody I've built financial control processes into companies, I'm constantly thinking, well, where's the control in this process? Where's the budget approval? Where's the manager approval? And so as you start documenting those conversations, you start to visually see where things are going and what's driving the money. And then you just circle right back to the cash with that, armed with that information. When you circle back to those financial statements and those bank statements, now you have a better idea of what you're looking for, and the pieces of the puzzle start to come together, and you can figure out what's happening, whether it's paying fictitious vendors, whether it's, management approving fake invoices. there's a lot of things that go on behind the scenes, but it starts with cash and questions, and then you can start to put the picture together.
So this is another instance where the sooner we are involved as forensic accountants, the better, because when you first go into that organization that needs assistance and is asking for help, the perception is a little brighter from everyone involved. They are more willing to provide information and answer questions in a positive, upbeat way at the beginning. But as as time passes, tension grows, and a lot of people in the accounting department start to feel I think a little nervous about the security of their jobs, and they become a little bit less less interested in sharing information and answering questions. That doesn't mean that they are committing fraud. It just means that they're a little bit insecure in their position, because now all of these external parties are coming in to evaluate the financial health of the organization. And so people in the financial departments and accounting department are going to be a little bit nervous. So if you can involve us sooner so that we can start to ask questions like kind of at the same level, then I think that really helps, because one, we're asking the right technical questions. And if those people do have a good technical background, then they're going to appreciate the face value of our questions and the fact that we're kind of communicating as one professional to another in the same similar industry. And so I think that that's a really good starting point. And then with regards to Andrea's comments about the cash and the bank documents, that's another situation where, and I've said this, in every case I've ever worked on, the sooner I'm involved, the better. When we're talking about the bank records, one of the reasons why it's really good to involve a forensic accountant early on, instead of waiting, a couple years until you get closer to those disclosure deadlines, which happens quite frequently, is that the time period for the bank's, requirement for retention of records continues to lapse. And so let's say I get involved in a case where the attorney waited 2 years, and now maybe we're not able to subpoena all of the records that we need. And this is probably a good time to maybe a little off topic, but probably a good time to mention that when you're involved in a case and it appears like you might need a forensic accountant, because there are questions about how cash was handled, how assets were handled, etc. But you look at the documentation that you have available and you don't see much. So you think, well, there's not much here, so I don't know that a forensic accountant could really help. That's a really good time to call us, because there have been countless times in my career where I've been handed a very small, box of documents, or a random, hard drive with some documents on it. And as forensic accountants, when we're trained properly and experienced, we are able to look at that small little stack of documents, this big, or that single box of records that's, randomly marked financial docs in black Sharpie from storage. And we're able to take that box of documents and turn it into an analysis for you, an expert report, an economic damages calculation, something that we can testify to in court, because we're able to look at that, small stack of documents and prepare for you a big, giant, long list of all of the bank records and bank accounts and credit card accounts that you might, be interested in filing a subpoena from the banks. And so, involve us sooner, involve us early, and, don't hesitate to involve us. Don't try to put too much pressure on yourselves as the attorneys, thinking that, you could probably save your client, money or whatever if you just kind of review the documents yourself. Because if you involve us, like we're trained, just as you're trained, we're trained to review those bank records, very, in a very quick and efficient way where we'll be able to turn around something of value to you and your client.
Now, in real life, there are situations that are intentional, and then there are situations that are unintentional. Both can have a devastating effect on the company, but there is a huge difference. You may have a situation where owners or employees, for that matter, intentionally have money disappear. And then there are situations where money was just mishandled, misrecorded, whatever. How do these situations differ, and how do you actually find? You look at bank records. Okay, so there are checks, there are payees. All of these look perfectly legitimate at the face of it. How do you figure out that there is fraud, that there is something going on?
It's a good question. I think a lot of, in my experience, having a really strong understanding of the business model itself, and understanding what type of vendors would be legitimate, the location of those vendors. If you're just specifically talking about, if you just narrow it down to one little piece, which is outgoing funds, you can look at the business model, and if you compare that, and if you have a lot of experience in different types of business models, you would know the types of vendors and payees that you would see. You'd also know the type of payment system. When we get a client and I see somebody paying everybody through Zelle and Cash App, my hair on my neck goes up and I'm like, what are you doing? That's not the proper way to pay accounts payable. Versus you go into a regular corporation where they're doing a weekly AP run, where there's a manager review, a CFO or a controller review, and there's checks and balances on that work. And so where you start is you just start really understanding that business model. And then again, general ledger detail, bank statement detail. The challenge with bank statements is they don't have copies of the written check, so you have to request those all from the bank. So you can also make sure that the check, because a very common issue is you can write your check out in the general ledger to anybody, but that doesn't mean that that's who the check cleared from. So you have to pull the check back up to make sure that the actual physical check that cleared the bank, who was it actually written to? And that's where you can't trust the data in the financial accounting system. I can go into any accounting system and change the payee name unless it's a big system where, like an ERP system, where it's locked down. And you can void the check, you can re-enter the check if you see a lot of voided checks. If you see a lot of, if you have an open system with no locks and controls, those are big flags for me. And I just start with that, and you start digging.
Yeah, I think you also want to look and see like what the separation of duties is in the accounting department. Yep. If it's a large entity and there's like one person in charge of like multiple accounting tasks, like they're entering the checks into the accounting system, but they're also depositing them perhaps. That's probably not a good idea. It's probably a sign that there's a possibility that in the very least the tasks need to be divided differently. And worst case scenario, it certainly opens up the door for the possibility of fraud more. I think that on one hand, the way that we determine whether, somebody is maybe misusing the money versus somebody that's just making mistakes, is, with the help of the attorney and understanding the facts of the case, the situation that's involved. I think another kind of way that we see, mismanagement of money and fraud is when we see cash transactions. So a lot of times people talk about all of the exciting types of fraud, like check kiting and money laundering and vendor fraud and payroll fraud. And while these things do happen, a lot of times we're looking for cash withdrawals. Cash transactions, transfers from an account that's held by the entity to an account that's not held by the entity. And so as a trained forensic accountant, we are able to look at the bank records and say, that account that this was transferred to is not an account that I have any records for, and it's at a completely different bank. Can you please, subpoena the records associated with this account? And sometimes that will help us to lead, to understand that that account is not held by the entity, it's held by an unrelated party. And maybe that's where, the fraud is kind of buried, because on paper, it looks like it's just a transfer to another account. But in reality, it's a shareholder withdrawal or distribution or someone literally just taking money out of the entity. So I think that's, something to consider. And I think I'd like to add that, there are a lot of people that have, experience and training as a forensic accountant. But it's really important that you use, some level of skepticism when you're hiring a forensic accountant, because you want to make sure that the forensic accountant that you are retaining is properly trained and experienced, and that it's really their specialization or their area of focus and concentration. Because people that are trained to do forensic accounting and kind of purely practice in the forensic accounting arena or similar areas are trained to be able to identify where the problem is without digging a hole too deep. And so someone that's that doesn't have the experience or proper training as a forensic accountant and is trying to kind of dabble in that area or find their way into it, should have kind of a mentor that's more seasoned, that's helping them alongside them, to ensure that they are employing the proper steps and the proper procedures and methodology, so that they don't kind of get lost in the weeds. Because when I used an example earlier of how oftentimes we're handed little stacks of paper to calculate economic damages or determine what bank records we need, but sometimes we have a small stack of bank records, but a massive amount of documents too. And when we have that massive amount of documents, it can become very overwhelming because you don't know exactly where to start. And so it's just a word of caution. I'm certainly by no means saying that you shouldn't hire a forensic accountant that's new to the field, but because everyone deserves a chance to kind of start somewhere, right? But that person should have a mentor or a manager or a supervisor that has more, significant experience in the area, that's working alongside them to guide them properly.
Here's an interesting question that was just posted, and I'll read it to you. Has the panel encountered any business that were being used for money laundering? 40% of illegal drugs in the world are sold into the USA, over 100 billion per year. If so, can you share your experiences as it relates to forensic accounting? So where do you start?
I have not.
It's basically the question. Not necessarily drugs, but you have this stack of bank records and you see the transactions. There may be hundreds, depending on the size of the company, thousands in a given month.
Yeah, I worked on one case where there was money laundering involved. It was a, bankruptcy related matter. So without, providing, I guess, too much details about the exact case that I worked on, there were hundreds of bank records, hundreds of bank accounts involved in this case. And so there was money laundering and there was check kiting in this particular instance. And it was a very interesting case to work on. And, to my knowledge, there were not drugs involved, but that does not mean that there wasn't. But they were, essentially laundering the money from one account to the next, and they were kiting checks. And as the forensic accountants, we had prepared, models, kind of, evaluating, both of those, types of fraudulent activity.
For the benefit of the audience, can you explain to us, what do you mean when you say check kiting? What is it?
So check kiting is when like an individual, I'm laughing because my kids asked me what this was the other day. And I was trying to explain it to them, but they're quite young. So hopefully this will go a little bit better. So check kiting is when an individual, or an entity, writes a check and deposits it into, another organization or another bank account. So they take the check, they write the check from account A to account B, and then they deposit it into account B, but cancel it from account A kind of like at the same time, in a way where the money kind of has already hit the other account, if that makes sense. And so then they're kind of getting the benefit of both sides of the check.
Okay. Now,
and sometimes it doesn't get caught. So if it doesn't get caught, then it's in the timing of the transaction.
So getting back to the earlier topic, you have the stack of, let's say, bank records, and you see all these transactions, many of them. Which ones do you look at? Because just in case I want to commit fraud, what should I not do so that you don't see it?
I look at them all. And I think that's where the difference between a forensic accountant and an auditor kind of is revealed. A forensic accountant is trained to look at every transaction. They say that we're looking for the needle in the haystack, but we're really looking at every single needle. We're looking at every number, and that's just what we're trained to do. Auditors are trained to look at a sampling of records, or a sampling of transactions. So, unfortunately, you're going to have to, I don't know, hide it pretty well, Rudy.
So I have to move to a state where you don't practice.
Yeah. Yeah. Don't get me or Andrea involved in the case.
Okay.
Yeah, I agree. You look at everything. You have to, because you can't take it on face value. And you have to take those records and you have to trace everything back to the source document. And if you can't find the source document, and then when you get to the source document, you have to make sure the source document is legitimate. I've looked up companies before on the division of corporations to find out who the owners were. I've looked them up to see, what state where the company created in. So you have to go even further, because just because you have a legitimate invoice doesn't mean that that's not somebody that there was somebody that works for the company that started that fake company. There was just a case on the news maybe a month or two ago, and it was a city treasurer, and she had started a bank account in almost the identical names of one of their fund accounts. And she was depositing the checks, and they did not have separation of duties. They did not have double controls. And she was depositing checks from the city into this account, which was her account, but vendor invoices were created. It looked completely legitimate. And it was by happenstance that somebody figured it out. It was an accident. She actually made a mistake, and one of the women in the office started to figure it out and put two and two together. And then they brought in the forensic accountants and the attorneys. And it turned out this woman had been stealing from the city for years and right underneath their noses. She had a big horse farm and a ranch and beautiful cars in this very small town. And she was the city treasurer, and there were no controls in place. And the bank account looked exactly like another account. And it went on for years. Very easy to do if you know what you're doing.
Are there any specific patterns or anything you look at when you look at the records? Specific numbers, patterns, something like that?
For me, it's dates, it's amounts, it's, unless somebody's very sophisticated. If you're very sophisticated, you're going to create a dummy corporation. You're going to put it that it's owned by another holding company. You're going to make the trail of that ownership so long that people have to dig and dig. And you're going to do things randomly. You're going to do, instead of taking $1,000, you're going to take $1,112.67. It's just really looking for that. And you really have to know, like, is this a vendor that exists? Do other companies use the same vendor? If you see a vendor name that's not consistent, well, what is this? Or you see transactions going through Wise or Cash App or Zelle or any type of cashing checks at the actual bank always gets my attention. Why are we cashing checks at the bank? We don't do that in this day and age.
Did I just hear you say you're also looking for amounts that are too round? Like,
That's just, I look at things like when I was working a case just recently for one of the law firms in Tampa. It's actually a current case right now in the Tampa area with a dock building company, where basically people were paying 50% deposits and the money was just gone. So I was actually tasked with looking up for preferential transfers, and there were about 10 bank accounts. And one of the consistent patterns that came out in that work was he would take 5 or 10,000 even usually on Fridays. And it was 5 or 10, and it was constant. And it was always to bank accounts, like Jennifer said, that were not within the group of accounts. And when we found out what those account numbers were labeled as it was the owner and his wife. So that one was pretty easy. Like he wasn't a real smart crook. But it can be anything. It can be creating this fake company where they're submitting vendor invoices through an invoice system, and there's no approval process. Or if you don't have a management approval, or you're comparing against budget or something around this, if you're just submitting invoices to an accounting department and they're cutting a weekly check run and there's no oversight and management approval or tie back to a budgeted item, then that's very easy to slide invoices through and create a fake company.
I had a church case
Okay.
where the accountant was withdrawing excess funds. So he decided to give himself a raise. And then he started, which wasn't approved. And then he started, increasing his salary. So he was taking a larger paycheck because he felt like he deserved a raise. It wasn't a terribly significant, amount of money. He wasn't taking out, $20,000 checks, but he was doing this, activity where that was a situation where there was no separation of duties, and he was able to just kind of write himself a bigger check or ACH payment, every month, every other week for his payroll. But the same individual had also been approved by the church to start bringing his vending machine business into the church. And so he became a vendor. And so now he was able to pay himself as a vendor however much he wanted also. And so he had the vending machine set up inside of the church, and the church was paying the vending machine fee and paying him as a vendor. But then the church was also like giving him extra money, which they didn't realize, for whatever he felt he deserved extra money for. And so that was how he was taking cash out of the church. So that was an instance where there actually was, kind of like vendor fraud and payroll fraud at the same time, but it was both completed by the accountant. I had another church case. Yeah, I had another church case, which was completely different. And I was involved after, a lot of money had gone missing. And this is a case where I actually testified, but essentially the board of directors of the church had kind of like split, and half of them had decided to kind of start another church. So they kind of like started construction on another church, and at the same time they started like funneling money out of the church accounts into like another account, which was for the new church. So it was very confusing because it seemed like they all kind of seemed similar, and like the account names were, kind of similar. So initially it seemed like they were just transferring money, like, to another account held by the church, but they'd actually, started these new accounts on their own, and they didn't actually belong to the church. They belonged to the board of directors. And so they had transferred all of this money into those, accounts. So that was an instance where, people were actually committing fraud. But they were doing it by literally just transferring money into other bank accounts. And so, both situations happen. Some are more, some are more, interesting than others, but they're all, kind of exciting at the end of the day, because ultimately the goal is for us to be able to, help to get the money back into the right hands.
Now, we are approaching the end of our time slot, but there is one probably final interesting question, and I'll read it to you. What does the panel think of the crypto industry, specifically FTX, Gemini, Genesis, and so on? What red flags should have stopped the fraud earlier on? Example, auditor failure, accounting control failure, and so on.
Did they have internal controls? Did they have internal auditors? I mean, I followed this briefly, you know, with this young, what was the, Sam Friedman?
Bankman-Fried?
Yeah.
Sam Bankman-Fried, yes.
If they're not required to have internal auditors or internal controls, then they, and even though you have internal auditors and you can have very tight internal controls, you can still have fraud. I was a controller of a very large corporation that's headquartered here out of Clearwater, and I was one of the controllers. There were 4 controllers, and one of the other controllers that had been with the company for 25 years, her daughter worked in the accounting department. And we found out that her daughter, who would reconcile the Staples bills for all 92 locations of this company, she had a charge. She still had a charge account with Staples underneath the corporation name when she was running it, the smaller offices down in Broward County. And she was buying gift cards on those Staples statements. And then she would reconcile the statements, pay the statements, and she was getting gift cards paid for by the company. And then she'd use those gift cards to go buy electronics and laptops and computers and then sell them. So you can have, we had an internal auditor who was on top of us 24/7. It was an SEC publicly traded company. We had financial controls. We had 4 controllers, a CFO, a shared services director, an accounting manager. Like we had and there were 70 people in the accounting department. And this happened right underneath our noses. And then a year later, they found out that 3 of the executive vice presidents were doing a debit card, a gift card scheme, and taking thousands and thousands and thousands of dollars in gift cards. So you can have the best tools, but it's just very difficult run using QuickBooks.
Okay, well, actually, here's
Sorry, I saw that question. You should not be using QuickBooks to run a large corporation's financial statements on top of that.
Well, for the benefit of the group, I'll read the statement. John Ray III, forensic accountant on FTX case, told Congress FTX was run using QuickBooks. John Ray is from Naples, Florida.
That's funny. Yeah, probably shouldn't be using QuickBooks.
No.
Well, let's not malign QuickBooks quite yet, because for smaller companies, it is probably.
For small companies, it's absolutely great. And you can have small companies that have fraud. You can have, this was $1 billion corporation that I worked for as a controller. And we had so many controls. We couldn't do anything that was outside of the lines. Like everything was a checkbox. And this still happened. And it was the daughter of one of the controllers that had been with the company for 24 or 25 years.
Oh.
And
she went to jail. She went to jail for it.
Did the controller actually know about it, or just the daughter?
No, just the daughter. And somebody just figured it out one day. I don't know if she went on vacation and I forget how it all went down, but this was somebody who was highly revered in this company. The mom had been the controller for the Broward County area for 20 plus years and was highly regarded. Of the 4 controllers of us, she had been there the longest, obviously. And she started when the company was in its inception. And so she was highly trusted. And so was her daughter, because her daughter had worked for the company down in a local office for years and years and years. But it was just an accident that it got caught, and then they prosecuted, and she went to jail for, I think, a year.
Wow. You know, earlier in the conversation, we talked about like the distress level. Like we talked about how when you go into an entity that's trying to, turn around, there's distress. The organization is distressed, right? That's the financial term. But it made me think about like all of my clients. And I don't think I've ever had a client come to me that's not in distress, whether it be an individual that's upset because, their relative is taking money improperly from, an elderly person's trust account, or whether it's, an attorney contacting me because, a client has lost money because another shareholder has, withdrawn X number of thousands of dollars. every single person that's contacted me has been in distress in some form. And so I think that, just kind of on like a closing note, when you hire the forensic accounting, you bring us in sooner to help. We can help to kind of ease some of that distress, and the sooner we're involved, the better, because we can kind of try to, reduce some of that distress, dissolve some of it, and hopefully, allow you as the attorney to focus more and not worry about on your case and what you're able to do, and not worry so much about, the tasks that, we're handling. You can entrust those to us. And hopefully that'll, lead to a less stressful situation and a positive outcome for everyone.
And as we're almost at the end, what are your final comments and your final advice to the audience? Andrea?
I think mine is, I'm going to mirror what Jennifer says, which is, and I'm going to approach it from just a slightly different point of view outside of the legal world, which if you're a certified turnaround professional, or if you're a restructuring officer, and you're coming in, you tend to be, I think, more operational, more globally looking at the company. If you can bring in someone like Jennifer, someone like me, to really go, okay, you go tell me go see what's happening in the financials and figure that out and report back to me. Because, a turnaround professional or a CRO, you're looking at the entire organization, trying to figure out everything from operations to HR to sales channels and marketing. And you really need somebody who can come in and really hone in on what's happening underneath the face of what the financials show. And even just to make sure maybe there is nothing going on, maybe that's not the course of the source of the problem, but having that peace of mind, knowing that there are the right controls in place, the right information is getting where it needs to be, the right approvals, that's critical. And so that you don't end up, you can maybe avoid some of the distress, but if you're already in distress, there's a lot more stress to go into this. And the faster that someone like Jennifer and myself are brought in, we're able to really uncover what's really going on and report, prepare a report and let somebody take kind of the action from there.
Yep, that's very well said.
Any final comments from you, Jennifer?
I would just say, kind of speaking to what Andrea said, like, let us do our job so that you can do yours. Don't try to take on, the stress of our job, in addition to the stress of your job as, an attorney. Let us help you.
All right. And with that, we are within less than a minute of our deadline. Not enough time for any other questions. I thank my two panelists, which are obviously outstanding forensic accountants. Now, anybody who has any suspicion of intentional or unintentional financial issues, you know where to go. Andrea is in Tampa. Jennifer is in Orlando, and I'm pretty sure they'll gladly help you. And with that said, I thank the audience for spending the time with us. Thank you very much. And I thank all of you for the questions.